Welcome to the Deep Dive. Today, we are plunging right into the latest from a true bellwether of the U.S. economy, Home Depot's Q3 2025 results. They just came out today, along with their revised guidance for the year.
Right. And our mission here is to, cut through the noise. We're going to analyze those mixed signals, figure out what's driving the anxiety, and what this all tells us about the housing and pro markets heading into 2026.
Okay, let's unpack this immediately because the market reaction was pretty dramatic.
It was, and it really reflects that tension between the top and bottom lines.
So what were the numbers?
Well, let's start with the good news. They actually delivered a revenue beat, pulled in $41.4 billion.
Which was against a forecast of what, about $41.18 billion?
Exactly. So a 2.8% increase year over year. But you have to remember, about $900 million of that came from their recent GMS acquisition.
Okay, so that helps the headline number look a little stronger. But if revenue beat, why the panic? The stock dropped over 5% pre-market.
That's the core question, and the answer is all about profitability and guidance. They missed on adjusted EPS, earnings per share.
Right.
It came in at $3.74, but the forecast was $3.84. And critically, this is the third straight quarterly EPS miss.
Ah, okay. One miss is a hiccup.
Exactly, but three in a row. That suggests a trend, a pattern, and it really erodes investor confidence.
And when you look past those big headline figures, you can see the pressure on the core business, can't you?
Absolutely. The performance metrics tell the real story. Total comparable sales comps were almost flat.
How flat?
Just a 0.2% increase overall. U.S. comps were even lower, up just 0.1%.
Wow, so basically zero organic growth.
Pretty much stagnation. And even more telling, the operating margin declined to 12.9%. That's down from 13.5% last year.
So that margin decline, that's a story about efficiency. I saw gross margin was flat at 33.4%.
It is. It means they're still buying and selling product profitably. The operating margin drop implies that their operating expenses, payroll, advertising, all that grew faster than their sales.
So the machine is just getting more expensive to run in this slow growth environment.
That's it exactly. They're investing heavily, and when sales growth is basically zero, those costs really start to weigh down the profits.
Okay, so if the cost side is under pressure, let's talk about demand. Where did the shortfall come from? The executive commentary pointed to one thing pretty dramatically.
The weather. Or, maybe more accurately, the complete lack of it.
Right. It was the calm when they were expecting a storm, literally.
Management was very explicit. They said results missed expectations primarily because there was almost no storm activity compared to, historical norms.
Home Depot always factors in a certain amount of weather-related repair business. Where did they feel that pressure the most?
In all the categories you'd expect. Roofing materials, power generation, think generators, and plywood. It wasn't just a small drag. It really changed their forecasts.
And you can see it in the monthly numbers, which is fascinating.
You really can. Comps were actually positive 2% in August. A decent start, but then they slowed to just 0.5% in September and then turned negative in October, down 1.5%.
So October was the real killer for the quarter.
It was the month where that lack of storm activity really hit the balance sheet and dragged the whole quarter down.
Okay, beyond the weather, they also pointed to broader macro pressures. Things like ongoing consumer uncertainty.
Yeah, concerns over living costs, affordability, and now job concerns and layoffs are creeping in.
And the housing market, that's still a massive headwind.
A foundational headwind. They noted housing turnover is at 40-year lows.
40 years?
Yeah, about a 2.9% turnover rate. It's incredibly low.
And why is turnover so critical for Home Depot?
Because new homeowners are the biggest spenders. When you move into a new house, you immediately start spending on renovations, repairs, customization.
Yeah, you want to make it your own.
Exactly. When turnover is this low, people are stuck in their existing homes. They're optimizing, not overhauling.
Which feeds right into this idea they mentioned, the deferral mindset.
That is the deferral mindset in a nutshell. Customers are pushing off those big discretionary projects, especially ones that need financing.
Because borrowing costs are so high.
Precisely. The small repair market is holding up, but that big-ticket renovation market is basically in hibernation.
But, despite all that, no storms, high rates, low turnover, there were some bright spots.
There were, and it shows the underlying business is stable. If you adjust for the lack of storm activity, management said the underlying comp was stable at roughly 1% for both Q2 and Q3.
So they're holding their own. And online sales were a big win.
A huge win. Online comp sales grew about 11% year over year. That's double-digit growth in an almost zero growth environment.
And they said that was driven by faster delivery speeds.
It was, which means their massive investments in all those distribution and fulfillment centers are actually paying off. They're making it easier for customers to buy online.
We also saw positive growth in big ticket transactions, those over $1,000, up 2.3%.
We did, but the nuance here is really important.
This isn't people suddenly remodeling their kitchens again.
No, not at all. The executives clarified this was driven by customers trading up for innovative, higher-priced products like new appliances or power tools, and the success of their specialized pro initiatives.
So it's more about market share capture than a change in the overall climate.
Exactly.
Okay, shifting gears to the future. Home Depot used these numbers to substantially revise their full-year guidance.
They did, and it reflects a much more cautious reality. Total sales growth is now projected to be around 3.0%.
Lower than before.
And comp sales are now expected to be slightly positive. So they're bracing for basically flat growth for the full year.
And the bottom line impact is what really hit the stock.
For sure. Adjusted diluted EPS is now expected to decline by about 5% year over year. That's a much worse outlook than they gave before.
And what about that operating margin?
Revised down to about 13.0%. That's a 40 basis point revision.
Which, just to be clear, is a big move for a company of this size. A 0.4% drop in their full-year profit margin expectation.
It is, and it forces you to look at their long-term strategy, which is all about the pro ecosystem.
Right. They can't control interest rates or hurricanes, so they're doubling down on what they can control.
And that is their relationship with the professional contractor. They want to capture a much bigger share of the pro's wallet.
Their new tech rollouts here are pretty impressive.
They are. They launched a new project planning tool, but the really interesting one is called Blueprint Takeoffs.
Okay, what did that do?
It uses AI and algorithms to generate accurate material estimates from digital blueprints, and it does it in record time.
So it's automating a process that used to be a huge headache for contractors.
A massive headache. It used to take weeks. Now they can do it almost instantly. That time savings is a huge value proposition.
It positions them as a tech partner, not just a store, which ties into their acquisitions like SRS and GMS.
It does. They're building a wholesale-esque platform with those acquisitions to capture the really big, specialized commercial contractors.
The ones doing huge roofing jobs or building multifamily housing.
The ones that the typical retail store just can't serve efficiently.
But that wholesale model has lower margins, right?
It does, and that's the margin dilution analysts were asking about. Together, SRS and GMS dilute the pro forma operating margin by about 60 basis points.
That's a significant hit.
It is, but they're accepting that short-term pain for what they believe is a long-term strategic gain. They're sacrificing some margin now to dominate the pro market later.
Which brings us to the most critical analyst question. Can Home Depot actually grow if the macro environment doesn't improve?
Right. If housing and interest rates don't help them, what happens?
And this is where they brought up that astonishing figure.
The $50 billion cumulative underspend.
$50 billion in deferred maintenance and remodeling just waiting to happen.
Yeah, it's a massive backlog. For scale, that's about a third of their entire annual revenue just sitting there as latent demand.
Wow.
So management's argument is that this need doesn't just disappear, it gets postponed. Their job is to take market share in any environment because eventually those repairs have to get done.
That leads to the question about fixed costs, though. Are all these investments in the pro ecosystem making them less flexible in a downturn?
A very fair question. But management said the organic pro effort is reasonably asset light. It's mostly people in IT.
And the big distribution centers.
They argued those serve all customers, not just pros. They're about increasing delivery speed for everyone, which we saw drove that 11% online growth. So it's a universal investment.
Got it. And they said other pro costs like sales incentives and their truck fleet are variable.
Right. They shrink when sales shrink. So they're trying to mitigate adding huge new fixed costs.
And are we seeing proof that these acquisitions are actually working together? The cross-selling?
We are. They gave a specific example. A GMS roofing sale led directly to an introduction to Home Depot's sales team.
Who then sold the framing and the flooring for the same job.
Exactly. That's the synergy they pay for. That's the whole point.
Okay, and one last thing on the acquisitions SRS. Its sales were flat in Q3. Is that a concern?
Well, you need the context. The entire industry for roofing shipments was down in the mid-teens because there were no storms.
Ah, so for SRS to be flat in that environment.
It means they gained a massive amount of market share. They stayed afloat while their competitors were sinking. It's actually a very strong signal.
So to summarize this deep dive, the central tension is clear. You have strategic growth and great execution like 11% online growth, and these new pro tools fighting against some really powerful external headwinds.
And those headwinds are undeniable. 40-year low in housing turnover, consumer uncertainty, and no storms. The new guidance basically confirms they don't see that changing in Q4.
Which means their focus is just on what they can control, capturing share, digging deeper with the pro, and just getting ready for the eventual recovery.
Absolutely. And that brings us back to that $50 billion number. That's the key takeaway for me. We heard about this massive cumulative underspend in home repair.
A huge amount of latent demand.
So the provocative thought for you to consider is this. With high interest rates and low housing turnover today, what major economic shift or change in consumer psychology do you think will be the spark that finally unlocks that backlog? What gets people spending again?
A huge question, and one worth thinking about. Thanks for walking us through all the data.
My pleasure.